It sounds complicated, right? Like this big, intimidating world that you need a special degree just to understand? Well, what if I told you it's actually way simpler than you think? By the end of this explainer, you're going to know exactly what it means to own a stock. Let's get right into it.
You've seen this before, right? You're just scrolling through your phone and you see posts like this. Or maybe you see someone acting like they're the next big shot investor, telling everyone to buy this stock or that stock because it's the future. And you're just sitting there kind of thinking, what on earth are they even talking about?
If you've ever felt that little bit of confusion, trust me, you are not alone. What are these people actually buying? Is there some secret club you're not in on? Don't worry, we're about to peel back all the layers and figure it out together.
Okay, so let's just cut through all the noise and start with the absolute basics. What even is a stock? Forget the crazy charts, forget all the jargon you've heard. The main idea is incredibly simple.
That's it, seriously. A stock is just a small piece of ownership in a business. So when you buy a stock in, say, Apple or Amazon, you literally become a part owner. You get a tiny slice of that giant cake. It means you're no longer just a customer. You're on the team, and you have a real stake in how well that company does in the future.
Okay, but that brings up a pretty logical question, right? If you own a company and it's doing really well, why on earth would you want to sell off little pieces of it to total strangers? Why not just go to a bank for a loan? Well, companies are always hungry for money to grow, to build new factories, hire more people, or invent the next big thing. And yeah, they could take out bank loans, but that means debt, and it means interest payments. By selling stocks, they raise cash without owing anyone. It's like clean money they can use to expand. This is exactly how giants like Apple and Amazon grew into the massive companies they are today.
To make this all crystal clear, let's step away from the huge corporations for a minute and zoom in on a simple story. This will show you exactly how stocks work in the real world.
All right, so meet Reem. Reem has this amazing dream to open the coolest sneaker store in her city, and she's going to call it Fresh Kicks. She's got the plan, she's got the passion, but there's just one little hiccup: the money.
So she does the math. To get Fresh Kicks off the ground, for the rent, the inventory, all of it, she needs a total of $100,000.
The problem is, Reem only has $50,000 saved up. She's halfway there, but she's still got a big gap to fill. So what's she going to do? Well, instead of going to a bank, Reem gets creative. She decides to value her business idea at $100,000 and divides it into 10 shares, each worth $10,000. She keeps 5 for herself, for her $50,000. Then, her friend Schwab, who loves sneakers and believes in her idea, comes along. He buys 1 share for $10,000. That gives him 10% ownership. 4 other friends do the same, and just like that, boom! Reem has her $100,000. All right, let's hit the fast forward button. 5 years go by, and Fresh Kicks is a huge success. It's so popular that Reem has opened 2 more locations. The business, which started out being worth $100,000, is now valued at a whopping $300,000. That cake got a whole lot bigger.
So, what does this mean for our investor, Schwab? Well, in this amazing success story, his 10% share that he bought for $10,000 is now worth $30,000. That's a $20,000 profit just for believing in Reem's idea. But, and this is a big but, investing isn't a guaranteed win. What if the store struggled? If the value of Fresh Kicks dropped to $80,000, Schwab's share would now only be worth $8,000, meaning he'd have lost $2,000. This is the heart of investing. The chance for a big reward always comes with risk.
Okay, so we know what a stock is, we see how it works in our Fresh Kicks story, but where do you actually go to buy these things? It's not like you can just walk into an Apple store and ask for a share, right?
You go to the stock market. And honestly, the best way to picture it is like a giant online mall. But instead of shops selling shoes and phones, you have thousands of companies selling their shares, their little slices of ownership, to investors all over the world. It's the central place where buyers and sellers meet. And listen, this isn't just some far-off thing that only happens on Wall Street. We have huge, powerful stock markets right here in the Middle East. You've got the Saudi exchange, Tadawul, which is massive, the DFM in Dubai, the EGX in Egypt, and so many more. These are major hubs of business. And the best part is, today you can access all of them from an app right on your phone.
All right, so once you're inside this big mall, you're going to notice that not all stocks are the same. It's kind of like buying tickets to a concert. You've got your general admission tickets, and then you've got your special VIP passes. The 2 main types are common stock and preferred stock. Common stock is like that general admission ticket. It's what most everyday investors buy. It gives you the right to vote on big company decisions and has huge potential for growth, but it's also got higher risk. Preferred stock, on the other hand, is your VIP pass. You usually don't get a vote, but you get paid first. If the company pays out dividends, which are like little profit-sharing checks, you're at the front of the line. Preferred stocks are lower risk and are really built for steady income, not for that explosive growth.
Now this brings us back to a really fundamental question that a lot of people have. With all this talk about risk and potential losses, why on earth would you put your money in stocks instead of just leaving it in a nice, safe bank account?
Well, the answer really comes down to the potential for much, much higher returns over the long term. Now, of course, past results don't guarantee you what's going to happen in the future, but historically, a bank savings account might earn you around 7% a year. The stock market, however, has averaged closer to 10% a year over the long haul. That small difference might not sound like much, but when you compound it over decades, it can lead to a massive difference in your wealth. You're taking on more risk for the chance at a much bigger reward.
Okay, so if you're sitting here now thinking, all right, I get it, I'm interested, where do you even begin? Let's wrap this all up with 3 simple golden rules that every single new investor should absolutely live by. First, only invest in what you understand. Seriously, if you can't explain what a company does in one simple sentence, you probably shouldn't own a piece of it. Second, don't put all your eggs in one basket. This is called diversification. Spread your money across different companies and industries. That way, if one does poorly, it doesn't sink your whole ship. And third, please think long-term. The stock market goes up and down every day. Real wealth isn't built in a week, it's built over years and decades. And if you take only one single thing away from our chat today, let it be this. When you buy a stock, you are not just gambling on a wiggly line on a screen. You are buying ownership in a real business, with real employees, real products, and real customers. That change in mindset is everything. So I'm going to leave you with a final thought to get you started. Based on what you know now, and thinking about the businesses that you personally use, understand, and believe in, what would be the first company you might invest in? And maybe more importantly, why? Think about it. Your journey as an investor starts right there with that one simple question.